Hey, welcome back, options traders. And in this video, I wanted to give a comment to another trader who asked about the wheel strategy. And this comment came from, I believe it was a different forum that somebody forwarded to me. And the trader was saying, here's this wheel strategy. And he was just looking for some comments or some holes on it. So let's go take a look. What is the wheel strategy? And more importantly, what are some of the big risks that most traders will overlook? As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start with the strategy. Now, the strategy is called the wheel strategy. At least that's the way that he referred to it. And like a lot of option strategies, there's not a lot of standardization, so you can get a lot of different names. The way that I have heard this most often is the systematic writing strategy, which I have a video on YouTube talking about that. He calls it the wheel strategy, but it's the same idea. And here's what it is. He was selling 0 DTE at the money puts on the QQQs. And so remember that a 0 DTE has 1 day till expiration. It just expires that day. And he said that he was getting about 71 cents each time that he sold. Now, it turns out that these are either going to expire worthless or he will get assigned. And if he gets assigned, he's going to take the assignment. He's not going to buy it back. Now, if he does get assigned, he will then sell the 0 DTE at the money call. And so the idea is that you've created this system or this wheel where you're going to start out by selling puts to accumulate some shares, and then when you accumulate them, you are going to sell calls as a way to exit them. So you're really trying to use these options, calls and puts, as ways to accumulate and sell shares that you're willing to buy and sell anyway. Now, it turned out that over the past 21 days, he gave some stats here, and he said that over these 21 days, puts expired worthless 15 times. Now, during this month, I believe it was during November, there were the holidays, and there was about 21 trading days in there. So this was over a given calendar month. So he gets 15 times that the puts expired worthless, and he got assigned 4 times. So he's picked up 400 shares of QQQ. The calls expired worthless 2 times, and so for the total month, he had $1,442 in premiums, subtract off a $155 loss for about $1,293 in gains. Let's just call it $1,300. However, he also owns 500 shares of the Qs. And so these were the basic stats that he had posted. He said, here's what I've been doing. Any comments from anybody, any holes that I might be missing? And he said, other than the downside that he saw was the daily maintenance and commissions, which commissions are certainly a big part of it because you can see it's commission intensive. And so the commissions will add up. But there's actually a lot of potential problems with this strategy. Doesn't make it bad, but I think there's a lot of risks that would be overlooked by most traders. And the biggest one is that you're using the 0 DTE options as a way to enter and exit. Now, yes, I get it. We've talked about it with the square root pricing rule that the shorter the time frame, that the more of a premium that you are collecting, mathematically speaking. In other words, you're going to collect a lot more money selling 30 0 DTE options than one 30-day option. But we also have to look at it from another perspective. It's only 71 cents or 71 bucks. That's not much of a downside hedge if the Qs go against you. And so that's really the big problem that I'm going to call problem number 1. So you have to realize that short options have a negative expected value, which we've talked about before. That's one of the reasons that you get paid for it. That's why you're accepting the credit up front. That's what makes it a fairly valued deal. Option buyers are just the opposite. One of the reasons that you are paying a premium for a call or a put is because you have an expected positive gain. So just because you are collecting credits and have positive theta, all of the characteristics that most traders think makes this a free money strategy. They overlook the fact that starting out with these short options, you have a negative expected value. So that's the first thing. But in addition to that, because of this negative expected value, you are going to take a lot of assignments, which he already did in 21 days of using this strategy. So you are most likely going to accumulate large stock positions. So you have to be real sure, are you willing to stay on this strategy without deviating if you end up building a large stock position? Now, yes, I understand that if he gets assigned that he sells a call, that's part of the wheel strategy or the systematic strategy. But remember, selling calls doesn't guarantee that the price is going to rise. You could end up in a long sustained downfall. Think back to COVID. What if that happens and you're not willing to hold 1,000 shares of Q? So here's what it looks like graphically. Here's our risk graph. Let's say Qs were trading at about 380 when I shot these. If the stock price rises, you make dollar for dollar up. And if the stock price falls, you lose dollar for dollar down. But this is 100 deltas. It's just that 45-degree line that, again, shows dollar for dollar up and dollar for dollar down. But if you have 200 shares, or 200 deltas, you move from the black line to the blue. Notice that it's quite a bit steeper. And yes, that means you can make twice as much money if the index rises, but you will lose twice as much if it falls. What if you end up with 300 shares? Then you go to this. Look at how steep that's getting. 400 shares. So here's 400 shares or 400 deltas. Now at this point, if the index even falls just 3 points or 0.8%, it will eliminate all of the gains that he's collected so far. So if this is the current level, you're just operating in this little tiny narrow sliver where you can keep your head above water. Now also remember, if the stock price rises, you're not collecting these gains because you have sold calls. You've sold at the money calls. So all of this side is completely eliminated. It's just those little tiny 71-cent credits for the calls and puts that you are collecting. And in the business, again, we call that picking up nickels in front of bulldozers. It's a really risky way to go about it. But here's the thing that you want to keep your eye on, is this downside. So here's only 400 shares. Now remember, at this point, he's actually collected 500. So he's on this blue line. And what if it goes to 600, 700, 800, 900, 1,000? Look at how steep that's getting. And if the index falls down here to 360, that's just a 5% drop. It's not like we haven't seen an index drop 5% in a matter of days in the past. And this is going to put you right here into a $20,000 loss. And if you think you're going to dig your way out of it 71 cents at a shot without ever sustaining any more losses, you can see it's going to take you forever to get out of it, if you ever escape at all. So this is the first problem, that you are ultimately going to collect very large delta positions. Also remember, coupled with that idea is that when you're selling puts, is that you have this negative expected value. So it is definitely not for free. All right, so what's problem number 2, the big second problem? Remember, traders think that they will have long winning streaks. And in fact, that's kind of what he alluded to. Hey, look at all of the gains. I've had some small losses, but overall I've got these big gains. And again, the problem with this, we call this picking up nickels in front of bulldozers. It's a high-risk strategy for very little reward. But putting that aside, what could you expect from this strategy? And this is again where most traders are going to lose sight of just how fragile the strategy is in the long run. So let's look at an interesting question. Let's say that we have 2 equally good players at a game. Maybe it's tennis, or it could be backgammon, or maybe just to make it dead even, let's say that they are playing a coin flipping game so that we can truly say that both sides are equal. And the question we want to ask is how long before one person wins 2 games in a row? And the reason I like to pose this question is that you have to respect that when you are entering any kind of a strategy in the market, you are matched up with somebody who is also probably really good. Just because you know candlesticks and RSI and stochastics and everything else, remember everybody else does too. You can't beat the averages by doing what the average person is doing. So you have to beat it through skill. So let's just start out saying, okay, we've got 2 equally skilled people. How long before one person wins 2 in a row? And we could also reverse that. Look at the trader on the other side. How long is it before you lose 2 in a row? So let's see how long this strategy might be sustained if you are trading against equally skilled traders. And I think that's a very good assumption to start with. So there's a couple of ways we can model this. Let's look at Coinflips. If we have one player that wins 2 in a row, that could happen, let's say, by getting heads heads or by getting tails tails. So the very minimum would be 2 games to win 2 in a row. So if we look at the 4 possibilities for 2 coin flips, we could get heads heads, heads tails, tails heads, or tails tails. There are only 2 ways that you can win 2 in a row. So 2 out of 4, or a 50% chance that this game is going to end in 2 rounds. How likely is it that it would end in 3 rounds? Well, we can go back to our coin flips and we could say that in only 2 ways out of 8 possibilities would this end after 3 rounds. Now you might think, hey, wait a minute, it ended here after 2 rounds. Yeah, but that means we never would have played this 3rd round. This would have ended in 2 rounds. One player got heads heads, we never would have played the 3rd round. Nobody got 2 in a row here. Nobody got 2 in a row here. We got 2 in a row here, we never would have played the 3rd round. 2 in a row here, never would have played the 3rd. It's only these 2 possibilities out of 8 where we would have gone 3 rounds and therefore ended the game with one player winning 2 in a row. What if it took 4 rounds? What could we expect? Well, now we have this. Again, we have 2 ways out of 16. So one thing we can do is just say, well, what's the expected value of this? For 2 rounds, chances were 25%. Remember, that was heads heads, heads tails, tails heads, and tails tails. 25%. 2 ways for that to happen. Total probability of 50%. We multiply the 2 times that, we get 1. We do it for 3 rounds, we get 0.75. For 4 rounds, and so on. And so what we want to know is there an average for this? Is there an expected value? So I drew this out to 20 rounds just as an arbitrary number to show that eventually you start hitting a bunch of zeros. So we can add these up. And it doesn't matter how long we made this series, you're going to start converging on 3. And what that tells you is that you should expect, again, we've got 2 equally skilled players playing a game, that on average you're going to go 3 rounds before somebody wins twice or somebody loses twice. So again, you have to ask, how likely is it that you are going to sustain this over and over to stay on this winning streak? Keeping in mind, these are nickels in front of bulldozers. If you get run over, it's going to be a long time before you can dig out of it. Let's just try another one for fun. What would be the chances of it going 6 rounds before somebody wins 2 in a row? Well, we saw that it was a 50% chance that it would end in 2 rounds, 25% chance in 3 rounds, and we just keep going. So here's that it would end on the 1st round, 2nd, 3rd, 4th, 5th, and 6th. So if we just multiply those out, it's 98.44%. The chance that it goes beyond that would be 1 minus that, or roughly 1.5%. So if you think that you're going to go 6 rounds before you're going to win 2 in a row or lose 2 in a row, you can see the odds are highly stacked against you. And so really the big risk with this is to recognize that it is not sustainable. And again, that doesn't mean it's a bad strategy, it just means it's high risk. And you're taking a ton of risk for these little tiny pennies and nickels. And the chances that you're going to sustain that over time, let's just say that it's pretty close to 0. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.